In 1992, a single man broke the Bank of England. George Soros made $1 billion in one day by betting against the British pound. The British government lost $3.4 billion trying to defend their currency. They failed. But Soros wasn't the first billionaire to hold nations hostage. He was just the most famous. This is another story where money, power, and history collide. And nothing is ever as simple as it looks. When countries face financial crisis, they have two choices: accept help from international institutions like the IMF, or turn to private billionaires who can move markets with a phone call. The first option comes with political strings attached. The second comes with financial ones that are far more expensive. Most people think billionaires who rescue countries are financial heroes. Savvy investors who step in when governments fail. The media calls them market wizards. Politicians praise their quick thinking. History remembers them as the people who prevented economic collapse. The reality is more predatory. These aren't rescues. They're acquisitions. The mechanism works like a financial hostage situation. First, billionaire investors identify a country with structural weaknesses, high debt, political instability, or currency vulnerabilities. Then they take massive short positions against that country's currency or bonds. This isn't just betting against the economy. It's actively working to destroy it. The attack comes in waves. Currency speculators borrow local currency and immediately sell it for dollars or euros. This drives down the exchange rate. As the currency weakens, other investors panic and sell. The central bank burns through foreign reserves trying to defend the currency. Interest rates spike. The stock market crashes. At this point, the same billionaires who caused the crisis offer to help solve it. They propose currency swaps, emergency loans, or direct investment in government bonds. The terms are always generous to them and devastating to the country. Take Soros again. In 1992, he borrowed $6.5 billion worth of British pounds and immediately converted them to dollars and German marks. The Bank of England spent $27 billion trying to defend the pound. They raised interest rates from 10% to 12% in a single morning, then to 15% that afternoon. Nothing worked. By evening, Britain withdrew from the European exchange rate mechanism. Soros made his billion. British taxpayers funded it. The most ruthless example happened during the 1997 Asian financial crisis. Currency speculators led by hedge funds attacked Thailand, Indonesia, South Korea, and Malaysia simultaneously. The International Monetary Fund stepped in with $110 billion in loans. The conditions were brutal. Governments had to cut spending, raise taxes, and sell state assets to foreign investors at fire sale prices. The same investors who had shorted these currencies bought up banks, telecommunications companies, and infrastructure projects for pennies on the dollar. Thailand's largest bank was sold to foreign investors for less than the cost of a single office building in Manhattan. South Korean conglomerates that had survived Japanese occupation and the Korean War were dismantled and sold to American hedge funds. Paul Krugman called it loan sharking on a global scale. The investors had created the crisis, profited from the chaos, then positioned themselves as the solution. Malaysian Prime Minister Mahathir Mohamad was more direct. These people are not heroes. They are pirates with calculators. The political cover comes from complexity. Currency markets are abstract. Derivatives are invisible. Sovereign debt is boring. When a billionaire shorts a currency, there's no smoking gun. No obvious crime scene. Just numbers on screens and money moving between accounts in different time zones. The victims are always the same: middle-class families who lose their savings when their currency collapses, small businesses that go bankrupt when interest rates spike, and workers who lose their jobs when foreign investment disappears. The beneficiaries are always the same: billionaire investors and the multinational corporations that buy local assets at crisis prices. The system has evolved since 1997. Modern financial weapons are more sophisticated. Instead of directly shorting currencies, billionaires use credit default swaps to bet against government bonds. Instead of attacking one country at a time, they target entire regions. Instead of working alone, they coordinate through prime brokerage networks that can move $100 billion in capital faster than any central bank can respond. The European debt crisis between 2010 and 2012 followed the same pattern. Hedge funds bet against Greek, Portuguese, and Spanish government bonds. European taxpayers funded $1 trillion in bailouts. The same hedge funds that had shorted European debt bought distressed assets across southern Europe. Greek airports, Spanish toll roads, and Portuguese utilities were sold to foreign investors for fractions of their pre-crisis value. The political response is always the same. Politicians blame external forces, global markets, or economic fundamentals. They never mention that the crisis was manufactured by investors who then profited from the solution. Christine Lagarde, former head of the International Monetary Fund, was more honest. The people who cause financial crises are rarely the people who pay for them. The names have changed. The behavior hasn't. Today's billionaire country breakers use algorithmic trading instead of phone calls. They hide behind sovereign wealth funds and family offices instead of hedge funds. They target emerging market bonds instead of currencies. But the basic playbook remains the same. Create the crisis, profit from the chaos by the assets. The most recent example is Turkey. In 2018, currency speculators attacked the Turkish lira while President Erdogan was feuding with the United States. The lira lost 40% of its value in 6 months. Turkish companies with dollar-denominated debt faced bankruptcy. The central bank raised interest rates to 24%. Unemployment spiked to 14%. Foreign investors who had shorted the lira bought Turkish real estate, banks, and energy companies at 40% discounts. The same people who had created the crisis were celebrated as bringing foreign direct investment to Turkey. The moral paradox is perfect. The global financial system depends on investors who profit from national suffering. We call them market makers. They call themselves liquidity providers. The countries they target call them what they are: economic terrorists with Bloomberg terminals. The people who hold countries hostage don't need armies or weapons. They just need enough capital to break a currency and enough patience to buy the pieces. History doesn't repeat. It just refinances itself at better terms.